Let's get straight to it. The Fed meeting this Thursday morning on Australia's East Coast is going to be a cracker. Clifford Bennett from ACY Securities coming on the line right now to go and preview that. Clifford, welcome to the program.
Morning, David.
It's going to be a big one because we've got this tension underway at the moment.
Yes.
Because on one hand, the Fed is making it clear no rate cuts coming through this year. In fact, more rate hikes to come. But the market's got about 100 basis points of cuts priced in. How is this going to be resolved?
Well, I mean, it's very exciting, David. I mean, it's a little bit like the anticipation before the Sydney fireworks at the moment. Something's going to explode. It's either the idea that interest rates are going to go aggressively higher, or that stocks should be continuing to rally on the idea that the Fed will reduce its rate of hikes and even pause soon. I mean, I think what would happen is if the Fed actually only hiked by 25 points, people would get very excited about the idea, oh, does that mean there's going to be a pivot soon? And I mean, I've laughed at the word pivot ever since it was first introduced in this debate, because the Fed was never going to pivot, and they're not going to now either. If they do stop or they slow down, they pause at some point, it will be a long pause. It could be 18 months, it could be 2 years, who knows? But I think what people are underestimating, but stocks in New York belatedly began to price in yesterday in the last 12 hours or so, is that the Fed could in fact actually hike by 50 points this week. And I think that would be generating some serious fireworks were that to happen. The argument for that is the Fed has always said, Chairman Powell's always said, he's very happy to see the US economy slow significantly in order to avoid the long-term damage of high extreme inflation. Now, it's all very well that inflation's coming down, but it's still high, it's still extreme. And the number that no one wants to talk about, particularly the funds management industry, is that the PCE core inflator actually accelerated in the last month from 0.2 to 0.3%. The Federal Reserve won't have looked the other way at that. They will have seen that. They will have seen a currency that's well down. The US dollar's been weakening for several months now, and that is an inflationary force in the pipeline, yet to be seen. Also, oil prices globally look like they've bottomed. They might be a little bit volatile here, but they seem to be moving higher. There could be, in fact, a flare-up of the situation in Ukraine, which could again catapult energy prices higher. So the Federal Reserve will be seeing all of that. And then on top of all those factors, the Fed will be going, well, we need, and it's said, its number one objective really is to puncture that employment balloon. And employment, all the employment data last week was all still very strong. The Q4 data, it's backward looking, but it suggests, yes, the US economy is slowing, but maybe not as badly as some of us had first thought in the first instance. But the Fed will see that, oh, I've got room to do more hikes because I have to stop this extreme inflation. The Fed also has said, and knows all too well, that as the previous person on your show just said, George just said, there are services inflationary pressures still coming. We know that there are housing pressures still coming. And we know that gasoline prices have only just started to edge back up again. All of that makes it highly problematic, I would suggest, and it's not the mainstream view, but highly problematic to suggest that the Fed can now relax and slow to 25 points. Better to get straight to 5%, have that psychological impact on the economy and markets, get straight to 5%, then maybe think about slowing, but I wouldn't be surprised if we see another 2 50-point rate hikes, David.
Certainly it would go and come as a shock to the market, which is almost no bang centered on a 25 basis point hike coming through. If we were to go and get that backdrop where the markets are expecting a 25 basis point move, is there any way possible that Jerome Powell can go and convince the markets that no, they should be taking the threat seriously, that we're going to see rates higher for longer? Because all we're seeing at the moment is this commentary comes out, the market just laughs it off, says no, and continues to cut in rate cuts. That surely can't go and continue for too much longer. Yeah,
David, I think we have to be careful we don't get too excited about cutting rate hikes. I mean, because they're still rate hikes. I mean, the interest rate pain to the US consumer, the mortgage stress, the property prices in the US are already falling, bond prices are falling, the currency's falling, the stock market has fallen, it's had a spectacular rally at the start of the year, all on the idea of this Fed slowing or even pivoting, and all on the idea of a soft recession. I think both arguments are vulnerable. But we shouldn't get too excited about slower rate hikes. They are still rate increases. that will further compound the pain that is yet to flow through to US consumers and US businesses. So the impact of all of this is still yet to be fully felt, and it's going to be even greater as we move forward because the Fed is still hiking interest rates. So I think it's really very much the glass half full. I think it's almost barely a little drop left in the glass, but people are seeing it half full, that the Fed is that somehow smaller rate hikes are good for the economy. They mean more economic pain. Economic pain, the Fed has said, is what it wants. And at the moment, there isn't that much there, particularly on the employment front.